Hello, everyone. Just doing a quick flash economic update on several updates that we got last week, and also just a quick discussion on key levels to watch for the S&P 500, for the NASDAQ 100, and the price of oil. So I just wanted to give you a quick update on several items that have happened, and sort of my investment playbook for the next 6 to 12 months. So let's take a look at that. So a couple of really important and positive readings that we saw last week. Initial claims for unemployment came in way below forecasts. The actual reported number was 232,000. Expectations were for 247,000. So again, initial claims is often viewed as a forward-looking leading indicator for economic business cycles. So we are continuing to see very, very low reports of, people filing for unemployment benefits. And so that bodes very well for, the future of, the cycle that we're going through right now. The JOLTS report was also reported. Currently job vacancies stand at 11.2 million unfilled positions. That's far above the estimates of 10.3 million. Again, that number has been very robust. And it just goes to show how much difficulty. This is kind of a double-edged sword, because you don't want too many job vacancies, but at the same time, job vacancies do correlate in a negative correlation with recessions. So typically what happens is job vacancies really come down quite a bit, right at the onset of a recession. And we're actually seeing the opposite of that happening right now, where we see 11.2 million unfilled positions, way above the estimates. So it's kind of showing that we're not necessarily flashing recession, but on the same token, employers are having quite a lot of difficulty finding qualified candidates to fill jobs. Or, not just qualified candidates, but any candidates. Sometimes there's just no one, many of these jobs are just, employers are reporting that they just don't have enough interest from candidates to apply to these jobs. So it's kind of a mix of both, not being able to find the right talent, as well as just not being able to find any talent whatsoever. So you can read that in both ways, but that currently is not sort of flashing recession, at 11.2 million unfilled positions. So again, the job and labor markets do remain strong, but it is important that these job vacancies come down while job creation overall remains strong. That's what we would really like to see in a Goldilocks scenario. But right now we're seeing strong job growth, but also job vacancy growth. So if we want productivity and production to increase, we need to find the right workers for the right jobs. And right now that's not happening. So it's kind of a mixed bag, when you try to interpret that number. However, on other metrics, the consumer confidence number came out. That was a blowout, 103.2 reading versus 97.4 expected. That's actually very surprising, given that inflation has remained pretty high. But that's really telling you that consumers are kind of reacting in real time. Remember, the CPI is a lagging indicator, so that's going to turn last. When prices have already come down, the CPI will tell you that after the fact. So the consumer confidence number is more of a coincident indicator. Because that numbers came in at such a very, very positive and strong reading, that's telling you that overall the consumer is quite confident and optimistic about the future. So again, 103.2 reading versus 97.4. Again, that caught a lot of people off guard here, including myself. I thought that number would be lower, given where we are with high gas prices and other really high inflation rates when it comes to the cost of living, such as rent and home prices. But that number came in quite strong, so it's telling you that consumers are optimistic about where they are at currently and about the future. So that's also very important to keep an eye on. Chicago PMI, this is one of my favorites because it correlates very highly to the S&P earnings growth year over year. that clocked in at about 52.2. That was slightly below expectations, but because it's remaining above 50, that actually abated some concerns that we might fall into contraction territory. Some subcomponents of the manufacturing PMIs have actually fallen below 50. So we were afraid that the composite index would also be dragged below 50. Remember, anything below 50 means that the number is contracting, meaning production is contracting. Anything above 50 means production is expanding. So that was actually unchanged basically from the prior month. So the rate of change has slowed, from where we were about a year ago. But now we saw for the first time that decline in the Chicago PMI basically halted. And so now we're kind of, troughing out here at roughly 50 to 52. So that's also very good to see. We want to continue that, production expansion. So if we see a third, maybe we get a third time's a charm, scenario where, when we get the number in September, if that comes in at 52 or even 51, anything above 51, this may, start to really ease concerns that we're falling into contraction in terms of production. The ISM manufacturing, beat forecast. So that came in at 52.8, very close to the Chicago PMI reading. That was fed largely by new orders and an uptick in backlog. Very small uptick, but still an uptick nonetheless. But again, that came in very strong. So new orders are, coming in quite strong. You can see from the press release from the Institute of Supply Management, some of the anecdotes there were very, very optimistic, where, production is humming along, where orders are strong, inventories are low. So inventories are going to need to be restocked pretty soon. So that's bullish for new orders. So overall, ISM manufacturing came in, quite well. And then we ended the week with, the surprise 315,000 jobs created in August versus the 295,000 estimated. So this was almost a perfect week overall when it comes to the economic calendar. Very strong job and labor market, very strong consumer confidence, and strong PMIs from the manufacturing production, aspect of things. And then inflation expectations have continued to remain subdued, right? Gold has been basically range bound for the past 2 years, and it's actually at the low end of that 2-year range. Tips are not doing well. The copper to gold ratio is remaining subdued here. And inflation expectations from the New York Fed, they're all in check. So this tells me that the CPI, which, like I said, is a lagging indicator, I think that's getting ready to crack here. So we'll see what happens next week. We're going to get that big CPI reading, but I think, that number is going to start to come down. We saw that at 8.5% year over year, and basically 0% growth month over month. I think that could start to show negative readings month over month, which will really bring down that year over year growth. And so the trend might start to establish itself on the downside for CPI. If that happens, then that's quite bullish for stocks, I think. I think, just from an inflation standpoint. However, this is the big thing that I'm really starting to weight a lot more, which is that the bond market is actually clearly forecasting a recession. You can see historically, this has been a very, very accurate indicator for recession in the last 3 recessions. In fact, it almost got there right before the COVID recession. It was definitely heading there towards inversion, but you can see right before 2008, right before 2000, right before 1990, and right before 1980, all of those recessions were preceded by the 10-year minus the 2-year inverting, meaning the spread between the two falls below 0, which means that the 2-year yields higher than the 10-year. And right now we're, very clearly inverted at roughly, negative 35 basis point spread between the 10-year yield and the 2-year yield. That to me signals that the bond market is definitely sniffing out a growth slowdown in the next 6 to 12, maybe 18 months. You can see that there is sometimes a pretty comfortable lead time. You can see that in 2008, the recession hit in 2008, but the 10-2 spread inverted, quite well in advance of that, almost, a year and a half in advance of that. Same thing happened in 2000. The recession was officially recorded in 2001, and that yield curve inverted, basically at the end of 1999. So sometimes this can give you quite an advance notice here. So stocks can, continue to rally while the yield curve is inverted, right? But that's telling you that this is something that is brewing. It may not be super imminent, but something is brewing, and it's typically not good for stocks. So this is a trend that I would not want to bet against, and that's why I'm weighting this very, very carefully here. And again, a quick note about the inflation, right? So this is another reason why I think CPI is going to come down, because remember, every time the yield curve inverts, again, that's a forward-looking indicator for recession. And remember, what is one of the most powerful antidotes to recession or to inflation? And that is recession, right? Recession is usually the ultimate solution for high rates of inflation. And so typically when the yield curve is inverted, that is a forward-looking indicator of recession, which is also the ultimate, sledgehammer to inflation. And apart from that, backlog has eased quite significantly here. We saw a slight uptick last week in the backlog, but we're still quite, well within the range now, way below where we were at the end of 2020 and early 2021. So we've seen quite a stark divergence. You can see I've circled in red there between backlog and CPI. And backlog typically has roughly a 3 to 6 month lead time on the CPI. So I think, because of this, quite dramatic pullback in the backlog, this is yet another indicator for, why I think the CPI is going to come down, and that too come down in quite a dramatic fashion. So I wouldn't be surprised to see us exit the year with the CPI growing at roughly, 5%. If this if the backlog stays, at this, 50-ish level. So again, backlog easing, gold remains subdued. Just in summary here, tips remain subdued, inverted yield curve. And by the way, now we're seeing, even commodity prices essentially round tripping the entire surge that we saw post the invasion of Ukraine by Russia. So, crude oil has come down quite a bit. Gasoline, futures are down almost, over 25%, almost 30% now from the highs that were set. And many agricultural commodities like wheat and oats, other grains, they've all, essentially round tripped the entire surge that we saw after, Russia's invasion of Ukraine. So again, this is all, coming, the stars are sort of aligning here. That suggests that inflation may be topping out and reversing course. Remember, we never saw any of these things happen in the 1970s for, inflation. Everyone is comparing today's inflation to the 1970s. In the 1970s, we had sky high gold. We had tips. Well, we had, sky high, crude oil prices, gasoline prices, sky high agricultural commodities here. But now all of that has basically come back to where we were before this entire saga started. So again, all of this is feeding into the overall narrative that I'm trying to put there, which is that inflation, I believe, has topped out. But the critical question to ask is, why is inflation topping out? Now that we've established the what, right? The what is that inflation, in my view, is topping out. But the main question now is the why. Is inflation topping out because of production growth, which kind of leads into other factors like supply chain bottlenecks getting resolved, labor productivity increasing, Labor markets remaining strong, production therefore remaining strong. Remember, supply can also ease inflation. So is inflation topping out and coming down because we're seeing strong production growth? Or is it topping out because of an oncoming recession? That's the key question to be asking, right? So far, the indicators are not yet, flashing recession warnings, except for the yield curve. And so that's why that's the biggest thing that's giving me pause, because the yield curve is a forward-looking indicator. It's one of the ultimate forward-looking indicators. Before before ISM manufacturing can start to make moves, before initial claims start making moves, before unemployment starts ticking up, before any of that starts to happen, which is typical for a recession, the bond market understands that and sniffs that out first. That's why I wanted to, have this, quick, webinar here to just talk about some of the key levels that I'm watching, because I like to weight what the bond market is saying above everything else. So the bond market is clearly saying that recession is imminent in the next 6 to 12 months. So, but, as I said, the economic indicators that I'm watching here are not yet flashing that warning sign. So, because the forward-looking indicator is saying recession, whereas the coincident indicators are saying no recession, I'm watching the tape, right? We have to respect the tape. And in my view, this is just my personal opinion, but if the S&P and NASDAQ hold that June low, and I'll talk about why that low is very, very important in just a minute here, but the S&P and NASDAQ 100 must hold those June lows that we saw. If it doesn't, we risk significant technical damage. So that's for the S&P 500, that's roughly 3636. And for the NASDAQ 100, that's roughly 11,000. We have to hold those levels. If we don't, that risks significant technical damage, and that sets us up for, in my view, significantly more downside for the markets. Same thing goes with crude oil. The price of crude, remember, we don't want prices to remain too high, right? But we don't want them to break down too much either, because, remember, crude oil breaks down as do most other commodities like copper when there is recession, right? And so I believe that crude must hold above $62 a barrel, or else that risks, significant technical damage that is consistent with recession. So if we break below $62 on crude, and if we break below either 3636 or 11,000, that sets us up for quite a dramatic drawdown in the equity markets, in my view. So, although the economic indicators right now are not yet, truly bearish, in fact, many of them are quite bullish, we still need to respect the tape, because the markets are always forward-looking and they see things that we may miss. And so here's why I think these are important levels. This is a sort of a 50-year chart of the S&P 500. And you can see I've highlighted every bear market that we've been through in the last 50 years. And the green circles represent every bear market that has basically ended. And you can see that it has coincided with the 200-week moving average. So overlaid on this S&P 500 chart for the past 50 years, I have added the 200-week moving average for the S&P. And you can see that 9 out of the 14 times, I believe, there's been about 14 bear markets, right? And 9 out of those 14 have ended at the 200-week moving average. That was it. That was the bottom of the bear market. And the rally then resumed from there on out. So what we saw in June was exactly that. Essentially, it matched that 200-week moving average almost to perfection. In fact, I don't have the chart here, but it's actually even more pronounced for the NASDAQ 100 than it is for the S&P. The NASDAQ hit that 200-week moving average, down to the decimal point. and then we rallied off of that low. If that low holds, that's why I keep saying that the June lows are very, very critical from a technical standpoint, because it not only represents, a prior low, but it's also coincidentally the 200-week moving average. And historically, as I've shown here, the 200-week moving average has served as the bottom of every bear market. Just about out of 9 out of the last 14 bear markets. Now, when that 200-week breaks, which is where I've highlighted in red circles, we have seen significantly more downside after that break occurs. So we saw that happen in 2008. We saw that happen in 2001. We saw that happen in 1974 or 1973, and we saw that in 1970. So, and actually, I may have made a mistake here. That this right here should not be a red circle. That 1980. That was basically meeting that 200-week moving average. So there's been 10 times where the 200-week moving average has served as support, and 4 times that the 200-week moving average has broken down. And you can see that every single time that the 200-week moving average is broken down, you can see that the market has proceeded to drop, and I did the math already, but it proceeded to drop another 30% on average after that break occurred. So from the point that the break occurred to the ultimate bottom, on average has been roughly 30%. So if that happens this time around, that could possibly target 7,600 on the NASDAQ 100 and roughly 2,400 on the S&P 500. So that would represent a lot of further downside here, folks. So I am watching that 200-week moving average like a hawk. And if that breaks down, then we're setting up for a lot more downside here. I personally think as of right now that the June lows will hold. Why? Because the economic data as well as the earnings don't really justify any further weakness than that. I noted on prior webinars that as of that June low, both the S&P was trading at 17 times earnings. The NASDAQ was trading at roughly 19 times forward earnings. And that's after the fact that we've already had, Q2 earnings basically concluded. Analysts have now fully factored in everything that managements have been talking about and, future commentary. So we know quite well how the rest of 2020 will go, as well as the first, quarter or two of 2023. So we can say with pretty good confidence that these forward-looking estimates are going to be relatively sticky, and earnings estimates have really not come down all that much. We've seen earnings estimates stabilize for both the S&P and the NASDAQ now. We had seen cuts definitely for sure from the highs, but since the conclusion of Q2 earnings, we haven't seen too many more earnings estimate revisions to the downside. So from an earnings revision standpoint and from a broad economic indicator standpoint, I don't see why we should break down from the June lows. But as I said, that yield curve is not to be ignored. And because that 10s-2s yield curve is inverted, that's the bond markets telling you something that has not yet shown up in the data. Right? So therefore, something could ultimately show up in the data, which would then, change the outlook entirely to the downside. And therefore, those June lows could eventually break. So that's why I like to respect the tape a lot. And remember, the 200-week moving average has been quite reliable historically. So if that breaks, I would be very, very cautious in my equity allocation going forward. So the playbook of essentially is remain long here. The risk reward is favorable because as I showed, 10 out of the last 14 bear markets have ended at the 200-week moving average, and that's basically what we were at in the June lows here. But if that June low breaks down, we must prepare for a deeper and prolonged bear market. So I would focus the equity strategy on steady growth defensive companies. Companies that generate high returns on invested capital. Companies that have a sustainable moat in either R&D or brand loyalty. And companies that trade at reasonable PE and price to book multiples. And by reasonable, I mean just look at what has been their 10 to 15 year average PE. Are they within a stone's throw of the PEs that they traded at during the 2008 to 2010 era? If the stocks are way above those PEs, then there needs to be growth that justifies it. If it's not there, then the ROIC needs to be there. If that's not there, then that's a company at risk of multiple compression. So again, the earnings certain portfolio is a great place to start to find businesses that fall into these categories here. So hopefully this was helpful to everyone with regards to what levels I'm watching, as well as a summary of all the economic data points that came out last week. Again, keep an eye on that 200-week moving average. If that breaks down, I would say that that would be very, very bearish for the market, and historically, that has led to significant further losses for the equity market. So, from a risk management standpoint, now seems to be a pretty good time to be long, but be very, very cognizant of a breakdown of that June low. So again, any questions, comments, I'd love to hear from you. You can email us if you are a ZRS client at zrs@zacks.com. And if you're an Advisor Tools client, please reach out to us at cat@zacks.com. All right, thanks everyone, and hope to see you on the next one. Take care. Bye-bye.